The higher rate story is an interesting one. I think at the end of the day, it's been sparked by the realization that we're at peak liquidity. Central bank sponsored liquidities totaled about $20 trillion over the last several years, and that's not likely to grow a lot further from here. So that realization starting to dawn on markets, coupled with the fact that I think you have some news items and the fact that the market has actually become much more oriented towards momentum type strategies, meant that when you see corrections or you see some of that news flow, we get shorter and sharper moves.
Chris, who's Angie?
Well, first of all, it's a lovely name, and Kimberly, thanks for that. Angie stands for A, alternatives. Not is N, good enough yet. Angie, A-N-G-E-Y. And where we've come from is a place where, through central bank sponsored liquidity, cheap money, and not a lot of good alternatives, we used to call it TINA, there is no alternative in markets, so you bought stocks. We're starting to see the rise of an alternative. And with bond yields at very low levels and stock valuations at high levels, the alternative in some cases may be cash, but you got to look at it after inflation. So the real cash yield, if you take the Fed funds rate or 2-year rate, for example, and subtract personal consumption expenditure deflator, that's about 1.5, it's a measure of inflation, is 50 basis points. We've had a long period of negative real cash yields. It's now starting to be positive, and that could be a tipping point for investors thinking about how they look at risk in this market.
Chris, do you think there's opportunities for people to be buying any of these dips? If people haven't got a full exposure to equities, would now be the time to buy it, and where should they deploy that cash?
So, yes, I think the answer is yes, as long as it meets long-term goals, your risk tolerance, and those kinds of things. I think one of the interesting outcomes from a market environment that's more volatile is you'll get a bit more opportunities, either as market segment or some stocks go down further than others, or business dynamics, like in the health insurance industry, are starting to change. It will create those opportunities to be more selective and be more thoughtful in rebalancing your portfolios. That said, if you own a lot of hidden equity risk, we do recommend taking profits and rebalancing. Where we go from here are actually markets outside the U.S. Profit margins improving very strongly, and we don't think all the good news, at least around margin improvement, is built into stocks outside the U.S. So at the margin, adding non-U.S. stocks looks like the place to be for us.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.